Hey, welcome back. Have you ever jumped on what looked like a perfect breakout just to get absolutely slammed as the market reverses on you? Yeah, it's one of the most frustrating things in trading. But what if I told you that reversal wasn't random? What if it was actually a footprint, a clue left by smart money? Okay, let's get into it.
Welcome to AI Explains ICT. In this video, we're jumping straight into the core content from Month 3, Episode 5. We're going to give you a whole new way to look at the market, a lens that helps you see the difference between a real move and a sophisticated trap set by the big players.
So that's the million-dollar question, right? When you see price smash through an old high or low, is it really the start of a new trend, or is it a carefully engineered move designed to hunt for your stop loss? Well, the answer lies in understanding the hidden relationships that drive the markets.
All right, here's how we're going to break it down. First, we'll talk about the classic trader's dilemma. Then, we'll get into what a healthy market should look like. After that, we'll uncover the smart money footprint using something called SMT divergence. We'll even walk through a real case study, and finally, we'll show you how to build this into your own trading. Okay, first up, the trader's dilemma. You know that feeling? You see a strong move, you hop in, and bam, the market immediately rips against you. This happens all the time because there's a deeper market structure at play that, honestly, most retail traders just don't see.
And this right here is the key to it all. ICT calls this institutional market structure. Look, it's not about just staring at one chart in a vacuum. It's about analyzing related assets, specifically the relationship between the US dollar and foreign currencies, to figure out what the big institutions are really doing, whether they're quietly buying or selling.
So, how does this actually work? Well, before you can spot the manipulation, you first have to understand what a normal, healthy market looks like. And in a healthy market, there's this predictable, inverse relationship, a dance, if you will, between the US dollar index and major foreign currencies. We call this market symmetry.
The idea is actually pretty simple. As you can see here, when the dollar index pushes down and makes a new low, a foreign currency like the euro or the pound should be strong enough to make a new high. You see, they move like a seesaw. This harmony, this symmetry, tells you the trend is healthy and it's probably going to continue.
And the same thing works in reverse. If the dollar index is strong and it punches up to a higher high, we fully expect to see foreign currencies showing weakness and making a lower low. When you see this perfect inverse correlation playing out, that's a huge green light for the current trend.
So here's the bottom line on this. When the market is symmetrical, don't fight it. The trend is confirmed. Trying to call a top or a bottom in these conditions, it's just a low probability guess. The smart money and the smart play is to just trade in the direction of that flow.
But what happens when that beautiful symmetry breaks? That is when things get really, really interesting. A break in this relationship isn't just some random glitch in the matrix. No way. It's a signal. It is the footprint of smart money stepping in and actively tipping their hand.
And, as ICT himself says, this failure to move symmetrically is our big clue that institutions are making their move. They're either accumulating positions for a huge rally, or they're distributing, unloading their holdings before a big drop. This divergence is the tool we use to see what they're up to. Okay, here's our first example of this divergence in action. Look closely here. The dollar index makes a new lower low, right? That's what we'd expect in a downtrend. But look at the foreign currency. It fails to make a new higher high. It just can't do it. It's showing weakness. This failure swing is telling us that even though the dollar is weak, the foreign currency doesn't have the juice to rally. That's a massive warning sign that it's probably about to fall.
And here's the flip side. Let's say the foreign currency makes a new lower low, and it looks super bearish on the surface. But at the exact same time, you look over at the dollar index, and it fails to make a new higher high. The dollar is showing you underlying weakness. This tells us that move down in the foreign currency might just be a trap, a final push to grab sell stops before a major rally kicks off.
So, theory is great and all, but let's see how this plays out on a real chart, right? We're going to rewind to June 2016 and look at a classic example on the British pound versus the US dollar. This is where it all comes to life.
So, check this out. Here's the daily chart of the British pound. In the middle of June, price rallied hard, and it broke above a previous high. Now, to the average trader, this looks incredibly bullish. It's a classic breakout signal, and you can bet tons of people were jumping in long, expecting the price to just keep flying higher. But if we pull up the dollar index chart for that exact same time, we see a completely different story. While the pound was making that higher high, the dollar should have made a lower low to confirm it, but it didn't.
It actually made a higher low. You see that? That was the crack in the correlation. The dollar was refusing to go lower, and it was screaming that it had underlying strength.
Let's just lay this out side by side so it's crystal clear. The British pound makes a higher high. The US dollar index fails to make a lower low. The conclusion? This is a textbook example of what ICT calls SMT bullish divergence on the dollar. It was a dead giveaway that smart money was accumulating dollars and that the breakout on the pound was a total trap.
And look at what happened next. That move higher, it was a calculated hunt for buy stops resting just above that old high. ICT has a great name for this, turtle soup. It's a false breakout engineered to trick retail buyers and to trigger the stops of anyone who was short. As soon as that liquidity was grabbed, smart money, who had been distributing their long positions into this rally, pulled the rug. And the result was an absolutely catastrophic drop in price.
Now, the big takeaway here is that this isn't just a fun history lesson. This is a repeatable, analytical framework that you can apply to your own trading to get a massive edge. It's all about knowing what to look for beyond just a single price chart.
And to make this analysis way easier, ICT actually provides a practical tool for this. It's an MT4 overlay indicator you can get on his forum. The setup is really simple. You just add it to your platform as a custom indicator. Once it's running, you can just type in USDX and it'll overlay the dollar right on top of your currency chart. This makes spotting these critical divergences almost effortless.
So let's wrap this up with the most important things to remember. First, always compare foreign currency price swings to the US dollar index. Second, remember, symmetry confirms the trend you're in while divergence warns you of a potential reversal. That divergence is your secret window into smart money's game plan. Also, be super skeptical of breakouts at old highs and lows. They're very often just liquidity hunts. And finally, use all of this to establish a powerful, high-probability directional bias before you even think about placing a trade.
If you found this video helpful, do me a favor and hit that like button and subscribe to the channel. Got any questions? Drop them in the comments below and a real human will get back to you. Until next time, always ask yourself, is this a real breakout or am I the liquidity? Safe trading.